It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. I think some of you may have been taking off a couple of weeks, and so this could be your first kind of back on it, back engaged weekend. I don't know, maybe not. Have to see. But this is the show that takes the mystery out of your financial life, and we are delighted that you're joining us today. So thank you for that. Very happy about that. And also happy to remind you that the new year often brings with it many questions. And if you've got questions, we are here for you. We are broadcasting live from the Capital One Bank studios. I hope they're still the sponsor, Mark, or else we just gave them a nice plug. I don't know. I think they are. Anyway, just give us a holler. Lots of ways to get in touch with us. The easiest is send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. If you want to, and you're just hopping around the website, jillonmoney.com, maybe you're listening to past shows, or maybe you are starting to subscribe to our podcast, also called Jill on Money. Or maybe you're pre-ordering my book, which is out in less than a month. There's also a Contact Us button. So if you want to contact us, click on that button. Tell us a little bit about what's going on. And we would be just absolutely delighted to help you out. That is what David did. He is on the line from Kentucky. Hello, David. Welcome to Jill on Money and Happy New Year.
Hi, Jill. Thanks for taking my call.
Sure.
Question I have, I'm trying to decide on a financial advisor. About a year ago, my dad passed away, and he left my brother and sister and I some money that he had with Raymond James, and there were two different accounts he had. And I went ahead and stayed with Raymond James. That's the first financial advisor I've ever had.
Mm-hmm.
And I've not been too happy with that. And I'm wondering if I should switch to a fee-only advisor to look at my entire situation.
So why were you unhappy with the situation in staying there over the past year? What do you what did you want that you didn't get?
Well, when I met with the person there, we talked about the accounts that my dad had, and I also explained to him what I had in my 401k at work, and I have a couple of rental properties, and asked him for advice in general, and I never got that. And then the other issue is I just don't think I've been given much advice, and the fee is, it's a percentage based on the account value, and it just doesn't seem like I'm getting much for that.
Mm-hmm. So tell me about yourself, and maybe we can talk a little bit about the best type of advisor for you. So you inherited this money, but you are working still, right?
Right. I'm 51. I'm sure I'll be working for several more years, but my 401k at work is around $1 million. And then I have two rental properties. I have two kids at school, and one lives in each one of those. So
Oh, that's kind of cool.
Yeah, it helps for not pay for them. There's a little rental income. So I don't know. I would like to have some advice.
Yeah.
But I'd like it to. I don't feel like I'm getting, totally unbiased advice.
Yeah, I get that. And maybe because this guy didn't do that. And maybe, when your parents were alive or your father, he didn't want advice. He just wanted someone to kind of caretake the account. And there wasn't much advice to give. So if you are interested in a fee-only advisor, and, all these words sound similar, but there's a very distinct difference. Fee only would tend to steer you towards somebody who collects a fee to do financial planning or money management, either one or both. And that fee is either a flat fee or maybe it's an hourly fee. And the best way you can find somebody near you is to go through the NAPFA website. So that's the National Association of Personal Financial Advisors. It's napfa.org. And you can find an advisor, type in your zip code or your location, and you can talk to people. But it seems to me that, I'm guessing that the tantalizing part of your story to someone who is on a percentage basis is not the money you inherited, but that $1 million in the 401k. And someone who is a commission-based or even an asset under management-based advisor would say, I'll work with this guy for a little while, bide my time, build a relationship, and then when those assets are ready to be rolled over, boom, I got $1 million client. Now, on the other hand, a fee-only advisor might also, like to take over those assets eventually. But the immediate concern is, what is it that I need to help David out with? What are the concerns he has? How are we looking at his kids' college? How are we looking at retirement? And look, it might cost you some real money. Maybe it's going to be a couple $1,000s. I don't know. But I think that you will feel more confident, especially because anyone who is a NAPFA advisor is they could charge an asset under management fee, but they cannot collect commissions. And they are fee only, meaning that they really tend to be the types of folks who they lead with financial planning more than money management. And I think that's what it sounds like you're looking for. So that's my recommendation to you. I don't, like I said, I don't think that anyone hoodwinked you in any way, but it sounds like it's just not the right match to be using someone at a brokerage firm who just wants to manage money and not do full-on financial planning. Does that seem right?
Yeah, I think so. I mean, because I asked him to look at the entire situation, and he just hasn't given me, that type of advice.
Yeah, I'm going to guess when he tries to give that advice, it'll be just about the time he gets the transfer paperwork out. And by the way, maybe you don't need to have anyone manage your money because you're managing your $1 million already. Maybe you'll just have, open up your own. Where is your retirement account held?
John Hancock's the administrator, but it's mostly American funds.
Mm-hmm. Okay. Well, I mean, look, if I were going to just transfer that money out, the money you inherited, go to a discount brokerage or to a index fund family like a Vanguard, or go to a Charles Schwab or a TD Ameritrade. Use those funds, and keep your life simple, and then go and get advice. And that advice, fee only, again, for everyone listening, the National Association of Personal Financial Advisors. The website is NAPFA, NAPFA.org. David, thanks so much for calling. I think that you'll be happy. I think that you'll probably find what you are seeking. And it's a good lesson for all of us to make sure when we're talking to a new financial advisor, what exactly am I paying for? What services will you deliver to me? You can check out under our resources the 10 questions to ask a financial professional. It's right there under resources. Rock and roll. Okay, it's Jill on Money, and when we return, more of your questions. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with the program that takes the mystery out of your financial life. That's our job. If you've got a financial question, do me a favor. Email askjill@jillonmoney.com. You can always hop onto our website, jillonmoney.com. You can listen to past shows, or if you missed any part of this one, or you can go over to the tab that says the book and pre-order the book. So exciting. All right, let's go and answer some of your financial questions. Dianne from Connecticut is on the line. Hello, Dianne. What can I do for you?
So thrilled to talk to you, and thank you for taking our call. And you've been so busy, so good luck with your book.
Thank you. Thank you. Tell me what's going on.
Well, we're very blessed, my husband and I. We work for New York State when we were looking at both having pensions when we retire. And one advisor suggested that we look into taking the maximum pension and purchasing long-term life insurance, permanent life insurance. And we're just perplexed at what's our really best deal.
That's a very interesting question. So this is actually one of the few times that whole life insurance or some sort of permanent life insurance can make sense, but it's very thorny. Here's the premise. You have a number of options for a pension. One of those options is usually you get the highest amount based on your life only, right? So that's a pretty standard possibility. And then the other possibilities might be like, well, I get 100% of this money if it's just my life, but maybe I'd get 50% less or 75% less if my spouse were sort of along for the ride. And so one way to maximize the pension amount is to say, well, hey, I'm Diane. I'm going to get a big pension amount. It's based on my life. But if I were to drop dead, then my spouse would get nothing, but I'd buy life insurance to prevent the spouse from getting nothing. Now, here's the thing. It can really work well, but I am very concerned that you get a second opinion because this is one of those things where sometimes a salesperson is quite aggressive in the recommendation, whereas maybe somebody who is a certified financial planner or someone who's fee-based, not or fee-only rather, and not somebody who sells stuff might say, you know what, why are you doing that? So what I would suggest is that you get a second opinion. And so you know what I'm going to do?
What?
I'm going to have Mark just get the phone. He'll take you off the line. I want to find out exactly where you are, and I can give you the name of somebody who might be able to help you out as like that third eye on that, or that's that another set of eyes, a second opinion to really make sure that this is the most advisable action you could take. Because obviously life insurance is really expensive. So I don't want you to pay up for something that perhaps, I'm saying perhaps, because maybe you do need it, but perhaps you don't need it. So hang on a second. Mark's going to pick up the phone and we'll absolutely get you somebody to talk to. Now, for everybody else listening, this idea, it's often called pension maximization, is something that should be very carefully analyzed. And, I think that there are so many times where I'm asked these questions. Even I find it very difficult. There's a lot of calculations. And when you run a analysis of some sort of life insurance, there's always a number of variables that you're not so sure about. Those variables can be like, hey, what are you expecting interest rates to do? I don't know. It may be that, you're not so healthy. So the cost of insurance is really, really going to be expensive. So there's something. But I guess the most important part is that if you do need a second opinion, if you are seeking a financial advisor who doesn't get paid based on a commission of a product, it can give you some comfort that you're really on the right track. The place where you can find those types of advisors is NAPFA, N-A-P-F-A, and napfa.org is the website. That would be, to me, something that everybody can kind of take to the bank, if you will. That's a place where you can find somebody who is going to work in your best interest and also who takes a big picture view. It's not a big time sales pitch. You want to know, is this advice the best advice for me? Not unlike what you do when you have, maybe you're getting your knee replaced. Maybe you want to get a second opinion from a doctor. Maybe you'd rather talk to someone who's not a surgeon to get some information, because the people who are surgeons, what do they tend to do? They love to do surgery. I did that with my hip. I went to a doctor and I thought I was going to need a hip replacement, although I'm a little young for it. And as it turns out, I did not need surgery. And I think that Many of the times when we are sold something or advised something, it's important to know, is this coming from a salesperson or is this coming from an advisor? That's what you want to know. Those are two very different types of folks in the financial services industry. And I know it's hard. I know it feels like, oh, everything's on you and that you should be talking to someone who puts your best interest first. But guess what? This administration rolled back all of the fiduciary responsibility rules, meaning that there were rules in place for any retirement funds, just like this, where you would have to have someone who is touching you or giving you any particular information about this. That person had to be held to a higher standard. Well, that's all been rolled back. And yeah, we're waiting for the SEC to do something, but it's just not going to be the same. So you've got to watch out for yourself. You really have to take control of this. You have to make sure that the person who is advising you absolutely has your best interests at heart. And that's hard. I know. I think it really stinks when you have to do everything yourself. On the other hand, no one else is going to do it for you, man. So take matters into your own hands. Absolutely. Do the homework. Get a second opinion. And, I guess that the other piece of this is a good rule of thumb when you're talking to somebody. If you don't have my 10 questions to ask a financial advisor, it's on the website, jillonmoney.com. But a good rule of thumb is to ask a potential advisor or anyone giving you financial advice, are you held to the fiduciary standard at all times? Are you held to the fiduciary standard at all times? If you are dealing with someone who is, then I feel a little bit better. It doesn't mean that person is going to automatically give you great advice. I'm sorry to say it doesn't work like that. But I am 100% clear that when you actually ask that question, if the person is kind of right there with you and says, yes, of course I am. Okay. That to me is totally the place to start. Okay? All right. Breathe. Got it? You're good. Go to jillonmoney.com. There you can find those resources. You can find the link to the NAPFA website. You can also find the 10 questions to ask a financial advisor. And if you need to know more, all you have to do is give us a holler. Ask Jill at jillonmoney.com. And we would love to help you out. That's it. It's so easy. So you're not alone. We got your back. And look, I don't give financial advice for a living anymore. I do it with you guys. But even with this, you hear I give advice, but I couch it a million different ways. There's a lot of variables here. So don't listen to this and just absolutely do the next thing that you think is relevant to you. You call us, give us details, and then we can talk to you more. All right. You are listening to Jill on Money. And again, get in touch with us. Ask Jill at jillonmoney.com. We'll be right back.
If you've missed any part of the show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back with Jill on Money. If you've got a financial question, we would love to hear from you. Just send us an email. We'll get you on the air live. Ask Jill at jillonmoney.com. And if you're nervous, shy, we'll just read your email on the air. Just let us know what you got. Now, of course, when we read your email on the air, you might get top billing, top priority. People who come on the air with us live do get the priority. Just because we like to hear your voices. Just like that. All right, but I will get some done because we got to clean out our email inbox. Good best practice for your beginning of the year. Clean out email inbox for sure. This comes from who? Will, who said he wants a clarification on step-up basis. So he's talking about stepped-up cost basis. So here's the question. When passed directly through an estate, assets such as stocks and real estate get a step-up in basis to the market value of the day the owner died. But those assets passed through a bypass trust do not get the step-up in basis. Am I correct? Does the basis step up to in an IRA? Okay. So, two things. Number one is if you have a bypass trust, just a very easy, that is called a revocable trust, you will get a step up. Your heirs will get a step up in cost basis for sure. I'm pretty sure. Now I said for sure and I'm not sure, but I think so. I think that if it's revocable, if it's changeable, you get a step up in cost basis. If it's irrevocable, no, you don't get a step up in cost basis. And where you absolutely positively don't get a step up in cost basis is an IRA account because there's no tax due. So remember, when money comes out of an IRA asset, you pay regular income tax brackets, right? That's what applies. So the answer is step up is for assets that pass outside of the contract of the IRA. So, and I believe that, yes, you can double check with your attorney, but I'm pretty sure that's how it goes, Will. Thanks for writing. Okay. Cindy writes, I need help. My father-in-law is suffering from Parkinson's dementia. Oh, I hate these stories. He was a professor of economics. He did a great job investing the money. He and his wife are both retired. He's currently in memory care. He can barely remember the accounts he holds, much less how he intended to draw them down. Now I'm doing their finances for them. How do I draw down their accounts to generate a paycheck once a month and not throw them into a much larger tax bracket? Cindy, I think this is a case for you getting some help. And I think what would be helpful is to seek the advice of a financial planner, one who adheres to the fiduciary standard at all times, meaning they've got to put your best interest first. You may want to check out someone from NAPFA, N-A-P-F-A, NAPFA.org, because I worry that if you go seek the assistance of somebody with that query, what's going to happen is someone's going to sell you or try to sell you an annuity to give you that monthly paycheck. So, I mean, if you're going to do it yourself, really the best way to think about this is that when you got to know what their expenses are. You've got to keep that money for the whole year in advance in a cash account, meaning that it can be a part of an investment account, but it has to be in a money market. And then you can generate a paycheck and be able to do that. Now, if it's from a retirement account and you don't want to jump into the next tax bracket, you can just check out what the tax brackets are and then make a determination what will keep them within the same bracket. And remember, for those of you sort of doing planning work, right now there's sort of two big fat tax brackets for married filing jointly. The 22%, which starts on income earned above $77,400, it goes up to $165,000. And then the next bracket starts at just over $165,000 up to $315,000. You want to pull out enough money to keep them in that tax bracket, but also be able to pay their bills. But I do think you could really benefit from talking to a pro. These are hard decisions to make. And, I wonder also whether, how your mother-in-law is doing, how are her finances. I mean, this just takes a lot of coordination. This is one of those situations, I think, where you really get you get a professional involved. You may think of things differently. And so that's what I think makes sense. Okay, here's Christopher, who's transitioning from the Marine Corps after 24 years. Wow. he's interested in becoming a certified financial planner. Woohoo! I've managed my investments, and I was just never satisfied with the professional knowledge of advisors that met me as a client. In my limited research thus far, I'm realizing the training plans, industry knowledge, and compensation are different for practically every firm. I also feel that I have got many blind spots. I don't have the information desired to make an informed decision. I'm looking for purpose in my next career. I require the following 3 things. Using my interpersonal skills, check, you can do that as an advisor. Help people achieve success, check, you can do that. Work for an organization that has impeccable morals, values, and character. Hold it. Number 3 is where the hurdles lie. Okay. This is what I think, Christopher. I think you should start exploring the Certified Financial Planner Board of Standards website. Now, there are 2 websites. One is an outward-facing website for consumers called letsmakeaplan.org. But the other one is, Mark, is it cfp.net? Yeah. So the other one for professionals is cfp.net. And that might help you out. I think that's your first step. You can do some research there. And I think that if you're really interested in trying to keep your you want to keep your number 3 requirements, you want to stick to that, you may find yourself trying to do some work with someone who is a fee-only planner. It doesn't actually make it an absolute, but I think that may be a place where you might feel most comfortable. So good luck, and thank you so much for touching base with us. You're listening to Jill on Money. If you've got a financial question, send us an email. Ask Jill at jillonmoney.com. And by the way, don't forget, subscribe to our podcast. It's called Jill on Money. How about that? All right, we'll be right back.
If you've missed any part of the show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back with Jill on Money, and Mark is kicking my butt because he said we still have emails sitting in the email box from 2018, and that is not a very good way to start your 2019, I will tell you. But we're going to do our best to plow through. And so if you do have a financial question, first of all, of course, let us know if there is urgency on the time horizon, where you have to make a quick decision. But second of all, if you don't have a big time horizon issue that's looming, be patient. We're doing our best. If you want to get on the show, you'll always get preference with your question. That's the deal. Hey, you know what? I'm not asking you to go on TV. There's no hair. There's no makeup. You can change your name. You can change your city. You could disguise your voice. Just kidding. All right. So let's go talk to some folks about their fees, because you know what? A lot of people at the end of the year, what happened? You get all your investment accounts in, and now you're starting to tally up how much money you actually are paying in fees. And so here is a question from Michael, who said, I know that we should be looking for a fee-only planner. What's a reasonable fee? And he's got about $1 million. So it kind of depends on the complexity of what you are, of your situation. But, I think it's a pretty fair way to imagine that when people are doing fee-only planning for someone who's got an asset level of about $1 million, they are usually talking about, I want to say around $5 to $10,000, depending on the complexity. But it really is planner specific. So you go onto that NAPFA, N-A-P-F-A, napfa.org website. And that when you do that, what you can basically do is to start to find out which advisors, which planners are out there doing what, and whether they match what you need, and then talk about fees. But I think that's about right. Here's another fee question. I've got $500,000 in my 401k, and I'm paying $500 a month in financial services for a 401k? I need advice where to find the best financial company to avoid paying too much in fees. I don't know what those services are. So I don't know if you're talking about how are you paying $500 a month in fees? Is it a current or is it a rollover? I wonder if it's a current 401k. That's what we got to find out. This is from Beth. And Beth, we also need to find out, is somebody actually managing this money for you? That's something that's really interesting. So we need to know what the fees are and what they encompass, and then maybe we can help you out. Here's a question from Susan, who asks, what if someone has no heirs? Basically, if my life goes on as expected, I will need elder care after a long and happy life, so I need my money. I opened a trust years ago, but I never funded it. All I own is my home, and I have an annuity. I don't know who to name as an executor. People say name a trusted friend. Well, settling an estate is a pain in the butt. That's what Susan says. And while I have tons of friends, they all have plenty of estates they will have to settle, and I don't have such close relationships with them. Plus, your friends can change. Years go by. If someone becomes helpful to me in 20 years and I have something left to give, I would name them. But what if I'm hit by a bus tomorrow? You know what you can do? You can actually name an institution. There's a lot of people who will actually you will pay a trustee fee, but you can name that person, or sometimes lawyers do it, sometimes accountants do it, and sometimes financial planners do it. Sometimes small, groups at banks, and they'll be named as trustees. Now, it's expensive, but that's kind of your, listen, you got to name either a person or an institution to manage it. So maybe talk to your attorney about that, your estate attorney, and you can hopefully get on the right track. Okay? Okay, here is a question from Aaron, who was reading an article I wrote in the Chicago Tribune called Getting Started on a Financial Plan. And Aaron's like, now my head's spinning with questions. When you don't feel good, you call your doctor. When you're 2/3, you call the dentist. Who do you call when you feel as if you have no financial plan? Well, you call us. My husband and I are 52. We've got 3 teens, college freshman, high school junior, 8th grader. We got into credit card debt, and for a year we have not been charging and paying monthly. My husband is commission only, so each month we just don't know how much he'll get paid. Each year it seems we have to pay to withdraw from his 401k to pay taxes. This is problematic because we're taking money from retirement. We're also hit with early withdrawal. We don't have emergency savings. I guess my question is, do you know who we could meet with to set up a monthly financial plan as well as long term? You don't need a financial planner. You need to get a grip on yourselves. I'm telling you right now, this requires you to actually have a sit-down conversation, you and your husband, to figure out why are you guys spending more than you make? And you need to, and I don't think that you guys have a grip on that. I really don't. And so in order to actually, a financial plan would be very easy for you. You've got 3 big things to accomplish. You start first, even before you start the big 3, you got to track where is your money going. Even though he's got inconsistent income, generally speaking, you should know how much he makes. That means of that money, you can set some money aside every year, and you can start to plan accordingly. Number 1 priority, pay off that credit card debt. Number 2, fund an emergency reserve fund. Number 3, continue to put money into a 401k. But what I am clear about from reading this is that the reason you feel out of sorts is that you aren't starting with the most important aspect of every financial plan, which is you got to step on the scale, my lady. You got to figure out what's going on here. And you can only do that with the work of tracking where your money is going. I think you're probably spending too much money. I know that's a bummer, but that's it. Blew through a lot right there, my man, Mark. You're listening to Jill on Money. When we return, we'll do some more emails. And if you got a question during the break, hop on to JillOnMoney.com, click on the Contact Us button, and we will get you right on the air as quickly as we can. Be right back. You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Easiest way to get in touch with us is to send us an email. Ask Jill at JillOnMoney.com. And by the way, if you're futzing around on the website, JillOnMoney.com, there's also a Contact Us button. It's very easy. So just do that as well. All right. We keep getting tons and tons of questions about Roth IRA conversions. And here's one from Jeffrey, who wants to know, should he be taking advantage of the lower tax rate that we're going to have for the next 7 years to convert, actually now 6, to convert some of my money from a regular IRA to a Roth IRA. But here's what he says. But I don't have the money to pay the taxes from non-retirement assets. I'd be paying the taxes from the conversion. I know it's best to pay the taxes from funds other than the IRA, but that's not possible, at least for most of the next 8 years. Well, here's the good news, Jeffrey. Your answer is very easy. Don't do it. The money has to come from outside the retirement account for it to make sense. Okay? Just much easier. Okay. Here's a question that is from Joyce, who had a question about Don't Leave a Mess for Your Heirs, an article I recently wrote. And she said, my husband and I have been married for 45 years. We've got 2 married sons. We're retired. We've got good pensions. We've got $1.2 million in savings investment with an advisor. We're now living in Florida. We need to know what type of advisor we should be looking for to protect our money in the future. Most of the people we speak to want to take over our investments. We're not interested in doing that, but we want to get our will done, get trusts. We have no idea where to go. Hey, this is easy. You need to go to an estate attorney. You don't need someone to manage your savings and your investments. If you've got a broker or an advisor already, you need an estate attorney. And if you do something very simple, which is talk to your advisor in New York, who probably can find you somebody in your Tampa area, you need a Florida estate attorney. Ask some friends who did their wills. That's what you need to be thinking about. Good luck. Thanks so much for writing, Joyce. If you've got a financial question, we would love to hear from you. Shoot us an email, askjill@jillonmoney.com, and check out our website, jillonmoney.com. There you can sign up for our free weekly newsletter. Now, stand by. We're going to do a quick break, and then we're coming back. We got a whole nother hour of fun up next. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2, and we are broadcasting live from the Capital One Bank Studios. Jill on Money, here for you. I'm Jill. He's Mark. He runs the show. Mark, could 2019 be the year that you go on the microphone a little bit? Or not? You did it one time. I feel like people are just dying to hear from you. You know, Howard Stern was on, and then Robin came on the air, and you are part of the show. You are my Robin. Wow. Yeah, because I'm outrageous, like Howard, and you're on the straight and narrow. All right. You cannot control the markets. You cannot time the markets. What is within your control? It is taking advantage of anything in your tax life. And according to our next guest, his name is David McKnight, we are at an unprecedented low level of tax rates. And David McKnight wrote a book called The Power of Zero, about paying zero income taxes. And this caught our eye, not just because it's a catchy marketing phrase, because we know you're uptight about markets and we want to help you make money. So check this out. Here is an interview with David McKnight. Let's get to the book, which is called The Power of Zero. The foreword is written by a friend of the show, Ed Slott. It was like a moment where I just went. And so I'm just going to read the first sentence of his foreword. Taxes will be increasing. This book is a wake-up call to reality. Can you describe what the current tax environment is now that the 2018 Tax Act has gone through? How would you describe this current tax rate environment?
Well, Ed and I have both described it very similarly, which is there's a tax sale. Taxes, you're going to have to pay taxes sooner or later. You either have to pay it now or you got to pay it later. Taxes just went on sale. I used to tell people that we believe that tax rates somewhere in the distant unknowable future will likely go up, maybe 10 years from now. That's what the experts believe. But now with the tax cuts, they have a sunset provision. We now know the year and the day when they're going to go back up again, and that's January 1st, 2026.
What about this notion that once you have a tax cut, it is hard to sunset that tax cut, that it will somehow get put into permanent law. How do you respond to that as a counter to your argument?
It takes an act of Congress to prevent that sunset from happening. So some people believe that that provision could even be voted out of existence before 2026. But here's what has to happen. You have to have the same party controlling the House, the Senate, and the presidency. I don't know if that can happen. It takes an alignment of the stars to make this thing go away. So we're telling our clients that you have 8 years. Every year that goes by where you fail to take advantage of historically low tax rates is potentially a year on the back end where you could have to pay the highest taxes you'll see in your lifetime.
And as you note, one of the great stats is that essentially roughly 3/4 of every tax dollar, 76 cents of every tax dollar that the U.S. brings in is spent on 4 items: Social Security, Medicare, Medicaid, and the interest on the national debt. So part of your thesis is not just that this is going to sunset, but that there will be a need to raise more dollars for the government to pay out promised benefits.
So we've actually been filming the movie version of this book over the course of the last 6 months. We've interviewed all of, Ed Slott, David Walker, former Comptroller General. We even interviewed a guy named George Shultz. You may have heard of him, former Secretary of State. He's still alive. He's 98 years old.
Oh, my God.
We interviewed you. He's actually one of the brightest economists on the planet. He said, look, the real gusher here is Medicare.
Right.
We're going to have to keep borrowing money to pay for Medicare. And then as interest rates rise, the cost of servicing all that debt, he says, is going to squeeze out all of the other items in the budget, creating this real fiscal crisis. He says we are already at the crisis point.
Really?
Yep. He says we're already there.
When you talk about this, one of the things you put, I just highlighted this, that you say, with the exception of 2 years in the early 90s, let's put that aside, we haven't had tax rates this low in 80 years. And you told me a funny story that when you walked in, that when you will say to a client, who complains about taxes, how do you think your tax rate compares now to the past? What do they usually say?
They always say it's as bad as it's ever been. And the truth is, taxes today, and nobody likes paying taxes, so we acknowledge that, but taxes today are as low as we've ever seen them. Now, you could make the case that the Bush tax cuts, the highest marginal tax bracket was only 35, but you can't pay attention just to the number. You have to pay attention to the income parameters that govern those tax brackets. And to have a 22% tax bracket that starts at 77 and change and goes all the way up to 165, and then for 2% more, you can go all the way up to 315. To be able to have $315,000 of income where you could either earn it or convert it to Roth IRAs, that would have put you in the 33% tax bracket.
Even those top tax brackets, 39.6 down to 37, but also that the lower rate is applying to all that income up to that level.
Right.
It's pretty amazing, right?
Yeah, and I don't think there's enough attention being paid to this. I mean, when you see the media, they're saying, okay, how does this affect Joe mainstream America, right? Yeah. How much can he save in his check? How many loaves of bread can he buy with that savings? But the real question, I think, is for 75 million baby boomers who have a choice of either paying taxes today on their retirement savings or postponing the payment of those taxes till much further down the road, that they are going to save massive amounts of money by taking advantage of this tax sale. And if they let even a year go by where they don't strongly consider shifting money to tax-free investments like Roth IRAs, that they're missing an opportunity. And that opportunity will never, ever come back.
Well, let's give you a scenario. So I have a traditional 401k.
Okay.
I'm 60 years old. Should I actually make a choice to stop contributing to that tax-deferred account and instead pay the tax due and invest in a taxable account?
You could. I mean, in theory, if your income is low enough, whatever's in your taxable bucket is actually tax-free. You don't pay capital gains on that. So that's an important consideration.
All right, let me give you more information.
Okay.
I'm a married couple. I work. My husband's at home. I make $200,000 a year.
$200,000 a year.
Okay.
So you've been phased out of the Roth IRA contributions.
Exactly.
Okay.
Now what do I do?
So and are we putting the backdoor Roth IRA on the table or off the table?
On the table.
Okay, so we could do a backdoor Roth IRA, so long as you don't have a lot of money sitting in other IRAs, because that makes it problematic.
So explain in easy to understand terms. We've had Slot do this, but let's see if you're better at it.
I don't think
Explain the backdoor Roth and why having other existing IRA accounts could complicate it.
Yeah. So what the IRS says is that if you make too much money, you can actually put after-tax dollars into an IRA. And then in the very same breath, you can convert it to a Roth IRA. Because you used after-tax dollars to begin with, you could then convert it to a Roth IRA. But the IRS says that if you have a bunch of money in your other IRAs, you have to take whatever the percentage of that IRA is relative to the IRA that you're converting, relative to all your other IRAs, whatever, and then subtract it from one, and then that is the portion of tax you would have to pay on that conversion. So it feels like a double tax. You used after-tax dollars, and then you paid the tax on the conversion anyway. I don't know if that's a very articulate way of saying it, but the point is, if you have money in other IRAs, it may not be that great an idea to do the backdoor Roth IRA.
Okay, we'll get back to our interview about how you can save big money on your taxes. David McKnight will tell you how. Meanwhile, during the break, why don't you go onto the website, JillOnMoney.com. And there, what can you do? You can pre-order the book. The book is out next month, everyone. It's now weeks away. Weeks away. All right, I'm not going to get breathless like that. But anyway, it's the dumb things smart people do with their money. And we would love for you to pre-order that as a nice gift in advance of tax season, perhaps. Okay, stand by. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. You know, it's just a couple months away till you start preparing your taxes, and you will find out the full impact of the tax law change, which went into effect January 2018. So this is the first year you're filing. Things could be different, obviously. But here's what's not up for any question. Tax rates, they're low. You have to take advantage of the tax code for as long as this lasts, because don't forget, this has a sunset provision. To learn more about how to really better navigate your tax situation, we've got David McKnight, The Power of Zero. He is our guest, so here's more of our interview with David. So now let's just presume I've worked in 3 different jobs. I've got rollover IRAs, and you know what, David? I cannot do the backdoor Roth because I can't deal with all these other IRAs. Now, what should I do?
There are other options. Okay, some people like to call it the rich man's Roth, which is what I call the life insurance retirement plan, which is in my book, which is basically saying you do the opposite of what most people do when it comes to life insurance. Most people, when it comes to life insurance, they buy as much death benefit as they can for as little money as possible. Mm-hmm. Ed Slott talks about this a lot. You buy as little insurance as the IRS requires of you. You stuff as much money into it as the IRS allows in an attempt to mimic a lot of the tax-free benefits of the Roth IRA. There are no limits on how much you put in. So that's another way. It's not for everybody. There are some long-term care benefits associated with it that make it very attractive for baby boomers who are retiring. Most baby boomers right now are dealing with a parent who's going through a long-term care event. And they're saying, how am I going to deal with this?
You hope you die early.
Yeah.
Please, God.
And people aren't opposed to paying for people aren't opposed to having long-term care insurance. They're just opposed to paying for it.
Hey, you know what? I'd love long-term care insurance if you paid for it.
That's right.
For me.
That's right. So if you could find a way to get long-term care coverage without feeling like you're paying for it, what people struggle with a traditional long-term care insurance is you're paying for something you hope you never use.
Yeah, but get over it, dude, because you know what? I pay for auto insurance every year, and I hope I never use it.
I know. But this is, if your auto insurance costs you $8,000 a year and had the ability to go up on a whim.
That's the part of it that I think is ridiculous, that the
right.
premium increases. I'm not a huge fan of the life insurance because I feel like you got to pay for all these fees, and there's too many squirrely insurance agents who sell you crap you don't need.
Right.
So that makes me nervous. Now tell me what else I should do.
It's okay, I believe, to put money into 401ks.
Okay.
Do it up to the match, but not above and beyond.
Mm-hmm. And
then somewhere down the road, you're going to roll that into an IRA, and then you're going to shift it to a Roth IRA. So it's a 2-step dance there.
Taxable, tax-deferred, tax-free.
Right. 3 buckets.
3 buckets, right? Taxable, plain old investment account. Tax-deferred, these 401k, 403b, IRA. Tax-free, Roth.
Roth 401k, Roth IRA, Roth conversion. You can even make your 401k tax-free if you only take out up to your standard deduction, which is $24,000 in today's dollars. So to me, the best investment I talk about in the whole book is money that's still in your tax-deferred bucket, like your IRA or 401k.
Yep.
But if you can make that balance low enough, when the IRS forces you to take the money out at age 70.5, make that balance low enough so that your RMDs are equal to or less than your standard deduction.
Oh, that's really brilliant.
So here's the thing. What's the holy grail of financial planning? Finding an investment that gives you a deduction on the front end. It grows tax-deferred. You take it out tax-free. Part of the problem is if you have an IRA or 401k that's so big that your required minimum distributions are dramatically higher than $24,000 or the inflation-adjusted equivalent, then you're going to be on the IRS's radar. You're going to be in a tax bracket, and it's not going to be zero. And the reason it's called the power of zero is because, David Walker, former Comptroller General of the federal government, in 2010, he wrote an op-ed on CNN. He says tax rates are going to have to double to keep our country solvent. So if that prophecy came true, okay, the very best tax bracket to be in is the 0% tax bracket.
Yes, it's our favorite.
Why? Because if tax rates double, 2 times 0 is still 0, right?
I can do that math. I don't even need to take that CFP exam to do it.
That's right.
What is it that you think people just don't understand right now? What is it that tax rates really are low and they're concentrating on the wrong thing? Are they investing in the wrong way? How do you see this among your clients and the people that you encounter just in all these speaking engagements?
So I address a lot of people across the country, and I ask them, where do you think tax rates are headed in the next 10 years? And they all say they're going up. So they all recognize that tax rates are going up, and I even say, tell me why. And they say Social Security, Medicare, Medicaid, interest on the debt. So they know why. So I say, why are we still putting money hand over fist into 401ks and IRAs? And that's where, put it this way, Jill, there are $21 trillion in the cumulative IRAs and 401ks across America. There's $800 billion in Roth IRAs. That's a 21 to 1 ratio. Why, if we all believe in our heart of hearts, we sort of read the handwriting on the wall, if we believe that tax rates are likely to be higher in the future than they are today, why do we forego these tax-free alternatives? Because we're addicted to the tax deduction, right? We perceive that one of the great values of these retirement accounts is to get a tax deduction. Well, guess what? The true purpose of a retirement account is not to get a tax deduction. It's to maximize cash flow at a period in your life when you can least afford to pay the taxes. That's the real value of a retirement account. So even if people believe that they're going to be in a higher tax bracket in retirement, and that's something I think I debunk in the book, they're still putting money into 401ks and IRAs. And sometimes it's just a reflexive sort of activity.
Let's presume that your tax rate is going to rise in the future, but you work in a place where you pretty much only have this thing called a 401k, right? Yeah. Is there something that you should be, like if we had somebody today who called up and said, I'm 65, I'm retiring next year, I've got $1 million in my 401k, right? And I want to start paying the tax on it sooner rather than later. Would it be prudent for that person to say over the next now 6 years where tax rates are low, I'll just take the money out little by little and bite the bullet and pay the tax due?
Yeah, and it depends on what their tax rate is now. It really depends. I don't think I would make any sweeping recommendations as far as that goes. What I would tell people is that we've got an 8-year tax sale. If you feel like your tax rate is going to be lower today than it is in the future, let's stretch that tax liability out over 8 years. And this is what I tell people. You want to shift the money quickly enough that you get all the heavy lifting done before the tax freight train hits. Okay?
Right.
But you want to do it slowly enough that you don't rise into a tax bracket that makes you feel uncomfortable.
We had an interesting call from somebody who was self-employed and could really manage his cash flow in terms of like taking on a project, not taking on a project. And the question was kind of cool. It was like, hey, does it make sense to kind of artificially keep my income down for a few years here, right? And I can't save as much, but I could start converting more and more of my money at lower rates. Do you give up that current cash flow and potential savings to pay the tax that's due? What do you think?
If you find yourself in a position where you can manipulate revenue or what have you and that's great. I wonder what the guy's living on in the meantime. But if he can find a way to make all that work, at the very least, he should be maxing out his 10 in his 12% tax bracket. Goes all the way up to 77.4. So if he's got no income, why not max out that 12% tax bracket each and every year?
Right.
It's another big leap to go from 12 to 22.
Right. There's nothing in between, right?
No, there's nothing in between.
It's a funny thing,
it's
right?
a funny thing, but I think that the IRS somehow has this thing wired. But the other thing that people got to recognize is that you may not believe that your tax rates will double. I mean, I've interviewed all of the most important people in academia across the country. They believe tax rates could double. They're all looking at the data, and they all seem to be singing the same song on that. You may not think that tax rates will double. However, guess what? If you have all your monies in 401ks and IRAs and your wife dies or your husband dies, guess what happens to your tax bracket? You go from being married, filing jointly, to single.
Yes.
Your tax bracket doubles.
Pops.
Right. So it would go from a 12% to a 22 or a 24. So guess what? Even though you didn't believe anything I was telling you, your spouse died, and now you're at double the tax rate. So
wow.
Your tax rates are going to double no matter what, unless you and your spouse die on the same day.
Thank you so much to David McKnight for joining us. And if you've got a question, a tax question, maybe it's an investment question, why don't you give us a shout? It's Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. And you can also send us a note from the website, JillOnMoney.com. Just contact us button will pop you right into our universe. Okay, we will be right back with more of your questions.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
All right. I love to have you on the air live. You know that. However, we are still digging out from 2018's email inundated box. And I'm not complaining because I love getting emails from you and I love getting the questions. And we are even starting to use these questions on my daily Jill on Money minutes that are syndicated across the country. Mark, when we use a question for the minutes, are we sending people the audio answers? You're so good. So we're really trying to stay on top of that. Mark is the best. You should have been in a client service industry. Oh, wait, you are. You're keeping me. Am I your client? Wait, are you my client? Oh, wait, no. The callers, the listeners, they're our clients. Anyway, keep Mark busy. Keep me busy. We love to hear from you. Again, two big, easy ways to get through to us. You can email us, askjill at jillonmoney.com. But you can always just go to the website, jillonmoney.com. There's a contact us button right there, and we'll get your note. Also, while you're on the website, do two things. One, sign up for our free weekly newsletter. It's fun. We don't just plug our own stuff, although we do plenty of that. Don't get me wrong. I'm not that good a person. I do some shameless plugging. But we like to get other articles, other interesting tidbits that we come across. That's a good thing. So that's the weekly newsletter. It's free. You can also, right now, pre-order my book, The Dumb Things Smart People Do With Their Money. The Dumb Things Smart People Do With Their Money. It is going to be dropped on February 5th. It's around the corner. Why not pre-order it right now? You can pre-order it anywhere you want. We have links everywhere. So go to jillonmoney.com, click on the book, and you'll see it. It's fantastic. What else can you do there, Mark? You can subscribe to our podcast. We changed the name of the podcast. It's called Jill on Money now. Get it? This is a radio show. It's Jill on Money. The podcast, of course it should be called Jill on Money. How stupid of us. Why didn't we think about that before? We were trying to differentiate, but now we're done with that. We're all one big happy family. It's the Jill on Money universe. All right, let's get to some questions. Quit your yammering, Schlesinger. Joan writes, my husband and I bought land in 2008 for $250,000. We were planning on building a house, but he passed away 3 years ago. Oh. We had put the property on the market in 2014. I now have it listed for $59,000. Hold on. They bought land at $250,000 10 years ago. It's now on the market for $59,000. I never plan on building a home there. We pay $1,600 every quarter for homeowners association fees and taxes that are about $6,500 a year. I had asked my accountant about donating it. He said that it wouldn't be to my advantage. Do you have suggestions? I mean, I don't know. What does the agent say? Like, where can you fire sale this for something? I think that the reason that your accountant doesn't want you to give it away is that you probably don't qualify for a itemized deduction anymore, but you would have that big fat loss for a while. I would just talk to the broker and say, where can at what price can I fire sale this? 50 grand, 40 grand? I don't know. But you're right. You can just give up on it for sure. And find out whatever the price is and hit that bid and move on. I'm sorry. That's a terrible story. Okay, here's a single mom living in Florida considering a revocable trust. Will transferring my home into this trust cause me to lose the homestead exemption that I currently have on my home? It's a considerable tax savings that I'm enjoying right now since I've owned my home for more than 30 years. I have a will for now that was drawn when my daughters were minors. They're adults now. Why do you need a trust? Why are you actually considering a revocable trust? I have a sneaking suspicion that you don't need a revocable trust, and therefore you don't have to worry about transferring your home. Do me a favor, follow up. Tell me how much money you have, and tell me why you are considering, or someone is advising you to create a revocable trust. Because I have a feeling you may not need it. All right? So maybe let me know about that. Kathy is looking for a new financial advisor or planner. She says, I've got some funds that I'm seeking assistance with. I'm meeting with the firm shortly. Your 10 questions asked posted to your site are helpful, and I'll use those. However, this firm is connected to a large national brokerage. I'm concerned that their relationship may override my best interest, even though this particular firm, meaning probably a group, is a fiduciary. Do you have any suggestions on how to pose questions directly related to this type of relationship between a large brokerage and an independent investment firm? Yeah, you know what I think that the question is the firm that's doing the advising, are they independent and clearing through a larger firm? In other words, let's say Mark and I are the Jill on Money investment group. Let's say that we have we charge money to do investment advisory work, but we clear the business and we have accounts held at some third party like National Financial Services or Vanguard or Schwab. Then that's not the problem. If you're saying that, like, the advisors you're talking to, well, it's Jill and Mark of Morgan Stanley, but it's the Jill and Mark group within Morgan Stanley, then what you ask is this. You say, how can I be assured that you will put my best interest first above your firm? What can you tell me about that? Are you a fiduciary at all times? Do you actually do you disclose all the conflicts that exist? If so, can I have that disclosure? And maybe if you're feeling this way, you just avoid it. Maybe you go and find an independent person. There's plenty of great independent financial advisors and planners out there. You can find some of the best ones at NAPFA, N-A-P-F-A, NAPFA.org. You can also check out letsmakeaplan.org, which is the CFP website. And I think you'll be very happy in doing so. But I'm interested to hear the follow-up, and also I need a few more details about exactly what kind of folks these are. Okay? Make sense? Very good. All right. Blew through a lot right there, huh, Mark? You're listening to Jill on Money. If you've got a financial question, I'm not scared of my inbox blowing up. Just let us know what we can do for you. Ask Jill at jillonmoney.com. And during the break, go subscribe to our sister podcast. Just do it. You can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcast. It's called Jill on Money. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back with Jill on Money, and if you've got a financial question, we'd love to hear from you. because that's fun. I mean, I love the guests also. I learn a lot from the guests, but I learn more from you. And all of your questions, all of your honesty has really helped me understand the things that I need to do better, just about making sure you get information you need, talking to people that are important that we can connect you to, all of that. Okay. So last year, at the end of the year, I wrote an article about estate planning, and it just stirred the pot. We got tons and tons of questions. So I'm still digging out from those estate questions. And I know that this is a hot issue. Here is Keith, who asked a question about an estate planning article that I wrote. And he basically is complaining. He says, hey, you know what? You only talked about federal, not state. I know. I only have so many words. And that article is syndicated in all the states. So the question that is asked about your specific state or any legal challenges that are going on, that's state specific. So, you know, one of the reasons that I like to tell people to get a qualified estate attorney from your state of residence is simply for this reason. You know, like the state tax exclusion is over $11 million for an individual federally, but in many states it's lower. Some places it's zero. So what you need to do is make sure you talk to a qualified estate attorney. Okay? That's the most important piece of this. Here's another one. This is from Joe, who says there seem to be reputable online support help for creating your own legal forms for estate planning at a significant reduction in cost versus going directly to a lawyer. LegalZoom has one, and there are some state-specific forms. What's your opinion regarding the use of these types of services? At the moment, I'm single. My wife passed away earlier this year. I've got no children, and I plan on leaving my assets to the nieces and nephews. Other than my home, my plan is to leave most of the remaining assets via transfer on death or beneficiary designations. Thanks, Joe. You know what? So, look, if you don't have a huge estate, I guess it doesn't really matter, and if you're telling me that you're going to use LegalZoom or not do anything, then use LegalZoom. But I still prefer an actual human being to do it, because I think there are sometimes nuances. But if that's it and that's all you got, fine. You may not have to pay as much as you think. If you are worried about price, then yeah, sure, go to LegalZoom. Good luck. But I'm not endorsing that. I really still believe in a qualified estate attorney to do estate planning. And here's one from Betty. Betty is 90 years old. She's a widow. She's got no will. Her only assets are her $110,000 home and an investment savings account with $35,000. Both are held jointly with my daughter. She's my only heir. And my IRA account worth $150,000 is her, and she's the beneficiary. Is the home deeded jointly this way? Okay. Should I have it in my name only and a will naming her the beneficiary? Do I need a will for the small estate? Thank you for your comments. It sounds to me like you've already gifted your house. You put your daughter's name on the deed. Once you did that, you have now gifted her the home, which means you've also gifted her the cost basis of that home. So let me just give you how that works. You got a home, it's worth $110,000, right? Let's say you bought it for $50,000. If you just put your daughter's name on the deed and she now owns it jointly with you, she now has been gifted half of the house at your cost basis. So her half that she now owns has a cost basis of $50,000. For her half, it would be $25,000, right? So the problem with that is that, you created a tax liability for her where none previously existed. But I don't think you can go back now and do this. So I presume that you should probably leave it as is. In terms of, do you really need a will? I think that it's not just a will. We talked about this recently with an estate attorney. And, I think that part of the process of planning for an estate is also about a healthcare proxy. It's also about a durable power of attorney. And so although I think that what you called this was a small estate. It's your big life. And I still believe that you would need the help of somebody to help to craft that. These 3 documents, a will, a power of attorney, and a healthcare proxy, would really help your daughter also settle the estate more efficiently or deal with your death or a potential illness a lot more easily. And so I think that it makes more sense for you to try doing that, Betty, than just saying, I'll save the money. You got the money to do it, right? You really do. So why not do this the right way? I think that you would be well served. I really do. Okay. 1 minute. Hold on. I got one more to do here, Mark. I'm going to be fast. This is a question that is from Elizabeth about whether or not National Debt Relief Program is a good debt relief program. I think all these programs stink. I think you can mostly do it yourself. And so as a result, I'm going to say to you, don't do it. I don't know if it's good or not, but if you need to go pay off your debt, you don't need to pay another company to pay off your debt. Pick up the phone, talk to the credit card companies, try to negotiate something lower. All right? There we go. It's Jill on Money. Check out the website during the break, JillOnMoney.com. There you can do all sorts of fun stuff. Read, listen, watch, sign up for our free weekly newsletter. We'll be right back. You're back with Jill on Money. And if you've got a financial question, we'd love to hear from you. You don't have to just do it during the show. You can do it anytime. Just send us an email. Ask Jill at JillOnMoney.com or hop onto the website, JillOnMoney.com. Click Contact Us, and you will contact us. Here is an email from Cindy. Subject is pension terminated. There's about $40,000 in it. Cindy writes, I retired before 2014. I'm 59 years old now. I live with my mother as full-time help. I have no other job, and she claims me on her taxes. What do I need to do to protect my assets? Well, okay, so I have a lot of questions. It's going to require some follow-up. First question is this. You have no income? Is that I'm just trying to understand. So there's zero income? That's number one. 2, the pension that was terminated, you were probably given a number of choices of what to do with it. I would like to know what those choices are. Is this money that can be rolled over, this $40,000, can it be rolled over into your own IRA rollover? That would make it easy, because if that were the case, there's nothing that would be a protected asset. I don't know what you want to protect your assets from. Are you saying you want to protect your assets from maybe that she would no longer be able to claim you as a dependent? I don't think that this would matter if, again, it's qualified. But if you're talking about protecting it because you don't want to lose money, that's a separate issue. And if $40,000 is all the money you have in the world, by the way, then I would agree that you need to protect it and you don't want to lose any money. And probably your best bet is to do some combination of a high-yielding money market or savings account or CDs. And you can't mess around with this. Also, I also interested you didn't mention this, but I'm interested in understanding what's the game plan. Like, you're taking care of your mother. Are you the only child? Is there something you've done with your estate? Or her estate? Let me know. And last but not least, James says that he heard me on NPR talking about the odds of a lottery, and he said that you said the odds of dating a supermodel was 1 in 80,000. His question, what would my odds of dating a supermodel be if I won the lottery? I would say much higher. Thanks so much, Jim, and thanks to all of you for listening. It's been a great show. Don't forget, anytime, anywhere, just go to JillOnMoney.com, and we can help you out. All right, we'll see you next week. Thanks so much for listening.